Microsoft Corporation, stock ticker MSFT, currently trading at $414.11, just recently announced their latest quarter's earnings report. Now, this position is actually the second largest position in my personal portfolio. It currently makes up around 8.3% of my portfolio, and I have seen phenomenal gains from this position. I'm currently up over 56% on this Microsoft position. Now, let's go ahead and dig into the latest quarter's earnings report. Come over to Seeking Alpha and look at the latest quarter's earnings report. We can see they saw a beat on the top and bottoms lines. Earnings per share came in at $2.93, which was a beat by around 16 cents, and revenue was a beat by $888 million. If we go back over to the summary tab, we can see over the past month, this company is now up over 11%, and over the past year, up nearly 55%. So this company has been on an absolute rampage lately. So let's go ahead and dig into this earnings report just a little bit more. If we jump over to the Microsoft investors presentation, we can see they saw growth in all major segments of their business, including productivity and business processes, intelligent cloud, and more personal computing. In those relevant areas, they saw 12% growth, 19% growth, and 18% growth. Again, this came out to net income of around $22 billion, and when you divide it by shares outstanding, you get earnings per share of $2.93. Now, if we break this out even more, again, we can see a major area where they saw growth this quarter was Xbox content and services. They saw 60% growth. So what you're asking yourself is what exactly is going on there that allowed them to see 60% growth? Well, if you remember back in October, Microsoft was able to acquire Activision Blizzard. Now, this was not a cheap acquisition. In fact, if we scroll down, we can actually see this was an all-cash transaction coming in at around $68.7 billion. Now, this was a very strategic move by Microsoft, and we can see, according to Statista, the video game market is expected to grow at around 8.76% between 2024 and 2027. And Microsoft is clearly trying to put themselves in a position where they can benefit from this growth. Now, if we jump back over to Seeking Alpha, let's see how this move affected Microsoft's balance sheet. If we go over to the financials and click on balance sheet, what we want to do is scroll down and look at total cash and short-term investments. For the past decade, we can see, for the most part, they were sitting a little over 100 billion. But if you look at the last report right here, it's now sitting at around 81 billion. Again, that is due to the Activision Blizzard acquisition. Now, this doesn't necessarily put them in a bad cash position. In fact, they're still in an extremely healthy cash position. If we scroll down and look at the long-term debts for this company, we can see there's really not anything to be concerned about because they're sitting at about $45 billion in long-term debt. So the balance sheet is still in a very healthy area. Now, again, if we jump over to the statement of cash flows and scroll down, let's see how this move affected the statement of cash flows. If we look at cash from investing, you can see for the past 3 to 5 years, typically been sitting at around 20 to 30 billion. It was 83 billion for the trailing 12 months, but again, that is because of the Activision Blizzard acquisition. So when we look at the earnings report from a grand view, not only is Microsoft seeing phenomenal organic growth, they're also making strategic acquisitions to be a beneficiary of the future growth of the video game market. Now let's go ahead and look at this company from a dividend investor perspective. We can see the starting dividend yield sitting at 0.72%, so a very low starting dividend yield. But we know this isn't always necessarily a bad thing if they have the ability to grow dividends at a rapid rate. So let's go ahead and click on the dividend tab and go over to dividend history. We'll scroll down, and over the past 10 years, we can see they were able to hike dividends going from 28 cents per share all the way up to now 75 cents per share. So a very consistent track record of growing dividends at a rapid rate over the past decade. When we look at these dividend growth rates, we can see the 3-year dividend growth rate, 10%, the 5-year 10%, and the 10-year dividend growth rate sitting at 11%. So a really nice job from this company growing their dividends over that time period. Now, none of that means anything if those dividend payments aren't safe and sustainable. So if we jump over to the dividend safety tab, we can see right here our cash flow payout ratios sitting right at 20%. Now, what does this mean? This means the company is using around 20% of their free cash flow to pay out dividends, so they still have around 80% of their free cash flow to do things like reinvest back into the business and buy back shares. So it's important to remember, just because a company is paying out a dividend doesn't mean its best growing days are behind them. This company still has plenty of room to grow because of their low cash flow payout ratio. Now, obviously, we need to see growing free cash flow for those dividend growth rates to be sustainable. So let's jump over to the statement of cash flows, and what we want to look for is free cash flow per share. we want to see solid growth over the past decade. And if we come right here and look at this charted out, we can see Microsoft has done a phenomenal job of growing their free cash flow per share over the past decade. They've gone from $3.26 free cash flow per share, and for the trailing 12 months, it's now over $9. So again, phenomenal track record of growing free cash flow. In my opinion, this is the golden metric that all investors should be looking at when considering your investment options. So from a recent earnings perspective, a dividend perspective, and a historical perspective, there's obviously a ton to like about Microsoft stock. But the question we need to answer is it trading at a good value at $414.11 per share? To answer that question, we need to jump into my stock valuation spreadsheet where we'll look at a few different valuation models like always. If you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So let's go ahead and come up here and plug in stock ticker MSFT and hit enter. And again, all of this data will automatically load in. We're currently looking at a 1,500 day change chart. Let's go ahead and zoom in and make it 365 days. And we can see obviously it has spiked up tremendously during that time period. The 20, 50, and 200-day moving averages all up by a decent bit. Analysts have a target price of $465 per share, even higher than the current trading price. If we come over here, we can see a beta of 0.9, so you should see a little less volatility with this company. Now, when we talk about valuation with this company, let's start on a very simple basis. Let's look at that price to earnings ratio. If we click on valuation here on Seeking Alpha and scroll down, we can see the price to earnings non-GAAP forward looking sitting at 35.42. So from a very simple perspective, that is a high price to earnings, but sometimes that can be justified. Now we can see Microsoft's 5-year average price to earnings sitting at 30.43. So even compared to where it has been historically, the stock does appear to be a little expensive at its current prices. But let's see if our valuation models agree. The first one we want to look at is going to be Graham's valuation, and this values a company based on their earnings per share growth. We can see here we have our forward-looking earnings per share, we have our growth rate projection, which remains high for Microsoft. We multiply by 4.4, which is the average yield on AAA corporate bonds, and divide by Y, which is the current yield on AAA corporate bonds. When we get all this together, the intrinsic value comes out to $263.21 per share, quite a bit lower than that current trading price. Now, the next valuation we'll look at is the discounted cash flow analysis. Basically, we're valuing Microsoft based on how much free cash flow they're going to produce in the future. So again, we're projecting a pretty high free cash flow growth rate at around 16% for the future free cash flows. We find the present value of those future free cash flows and add them together. We then add the company's cash and cash equivalents. And keep in mind, again, this is quite a bit lower now that they have recently acquired Activision Blizzard. But then we subtract out the total debt to get our equity value, divide by shares outstanding, and we come to a discounted cash flow price per share of $370.35. That's a little bit closer to the current trading price. Now, the next valuation we'll look at is the multiples valuation. And you can see the three companies we're using in this scenario. They're not perfect examples, but they are probably the best examples that we have. Now, we have Apple, Amazon, and Meta. What we're doing is we're taking their stock price, dividing by earnings per share to get their price to earnings multiple. We take that average PE and apply it to Microsoft's earnings per share, and we come to an intrinsic value of $437.06 per share, a little bit higher than that current trading price. Now, the last one we'll look at is the dividend discount model. Now, this values a company based on how much they pay out in dividends and how much that dividend is growing over time. And what I've done is I plugged in the quarterly dividends over the past 5 years so we can see those yearly dividend payouts and the dividend growth rates. And pretty consistently, it's right at 10%. So moving forward, I'm projecting a dividend growth rate of around 8.25%, discount rate of 9%, and we come to a dividend discount model price per share of $433. So when we jump over to our output tab, we can see the three valuations that we used in this scenario. We have Graham's at $263, DCF at $370, dividend discount model right at $433, and the multiples valuation also right at $433. Now, when we average all three of these together, we come to an intrinsic value of $375 per share, a little bit lower than that current trading price. Now, with a 10% margin of safety, you could see our acceptable buy price at around $337 a share. 20% margin of safety, acceptable buy price of right at $300 per share. Now, you have to keep in mind, Microsoft is one of the highest quality businesses in the world. They have a phenomenal growth runway with AI in the future, phenomenal and healthy balance sheet. They have a great management team, solid capital allocation, and phenomenal dividend metrics. This is clearly a company that's going to always trade at a premium. So unfortunately, in this scenario, if you want a high quality company right now, you have to pay a high price. Now, that's not to say that opportunities with this company don't come and go. For example, if we go back over to Seeking Alpha and click on Summary and look at just the past 5 years, we can see there's times when this company was trading as low as around $220 per share. And again, for example, I added some shares at around that price. I'm currently up over 50% on my Microsoft position, so you do have to be ready when those opportunities present themselves. So for the very long-term investor, I honestly don't think it's bad to consider Microsoft at its current price. Yes, you pay a premium, but there's still plenty of room for this company to grow their free cash flow and the share price will follow. So because this is already a large position in my portfolio, I don't necessarily feel the need to add more shares. But go ahead and let me know what you think of this company in the comments down below if you plan on buying or selling. And like always, if you'd like to join a community of dividend investors and get access to any of my spreadsheets, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.